Welcome back. I'm Pierre Daillie, Managing Editor at AdvisorAnalyst.com, and this is the Insight is Capital podcast. My very special guest today is Cole Smead, CEO and Portfolio Manager at Smead Capital Management. Cole, welcome. Thank you so much for coming on the show. I'm very excited about our conversation today.
Yeah, thanks for having me. This will be fun.
So Cole, before we begin, I'd like to introduce you for the benefit of those who don't know you. Cole is both the Chief Executive Officer and a Portfolio Manager at Smead Capital Management, where he provides oversight for all company operations. He's the ultimate decision maker for investment choices in the firm's international equity portfolios. Cole brings his, I would say, highly understated expertise to every aspect of the company's investment strategies. He's been an integral part of the firm since its establishment in 2007. Before joining Smead Capital Management, Cole worked as a financial advisor at Wachovia Securities in Scottsdale, Arizona. Cole is also a member of the CFA Institute and CFA Society, where he has been helping to inform and foster a renaissance in fundamental, active, bottom-up investing for investors through a low-turnover, differentiated value discipline, seeking wonderful companies to build wealth. So stay tuned. Thank you for listening. And while the music's playing, please hit that subscribe button. And if you like the podcast, we invite you to leave a review at Apple, Google, Spotify, or wherever you listen to your favorite podcasts.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Cole, welcome. It's really wonderful to have you. Before we get started, tell us about the genesis of your firm, Smead Capital Management, and then maybe we can get into your investment philosophy and personally what made you get into the business in the first place.
It's a great question. I consider myself a blessed individual in so many ways. I can tell you that God loves me. You know, I had the blessing of having a father who got in the investment business in 1980 with Drexel Burnham Lambert. Dad was in the retail brokerage business up until really the early 1990s and created this discipline back in the early 90s, but started using it for private clients on a discretionary basis back in 93. So what I love is, that's just a rich legacy to be born into and want to grow and foster, to your point earlier, and develop. I love that our 8 criteria has been around since 30 years ago, and yet at the same time, the criteria doesn't change. Markets do, and you get presented some really interesting things. But I have a huge appreciation for, like I mentioned earlier, how much my dad's legacy has blessed me, and how much he's informed me and taught me as an investor, and really, created me to be the man I am. To your point about our firm, we started in 2007. We launched our first U.S. mutual fund back in 2008. Early on, it was like, hey, great, you're going to get in the mutual fund business. You have a public track record. It sounds really adorable. We had to learn a lot as investors about how to distribute a mutual fund, what that looks like in the U.S. context. I would go further to say, we ended up launching a Luxembourg-based UCITS fund in 2013. We've learned a lot about, call it global distribution with the offshore business. And what we love is, we can serve investors, pretty much globally between those two fund structures. The only place that we actually have any issue is like in a retail Canadian context. So if any advisors out there know of a great Canadian partner, I'm all ears. But we also launched our international equity strategy in early 15 and then turned that into a U.S. mutual fund in early 2022. And so we look at this where it's a big world. We don't have to know everything about every company. We want to use our 8 criteria to find things that interest us. Just like, as you and I talked before, not every book interests me. Not every book pulls me in. The same thing happens in stocks. There's certain things you gravitate because of your personality, your discipline. And I think the creative process of learning is really what drives our investing.
Fantastic. And Cole, what other than maybe might seem like an obvious question, not everyone wants to get into the business that, their family's in. Often it's quite the opposite, right? So I'm curious, what inspired you? I'm guessing that, your dad must have been a terrific teacher and must have been the inspiration. But is that so? I mean, is that what sort of inspired you to get into the business? Was watching your dad in action and being interested in what he was doing? I'm sure you must have had many fascinating conversations when you were younger before that time.
Yeah, so I'll give you a couple that stand out to me. I'll never forget when I was in first grade. I was 7 years old, and it was like your dad comes to school day and teaches the kids what he does, and there wasn't a kid in the class that knew what a stock was. And I loved that. In other words, that was my edge. I knew what he did. And so I think about that as just the idea of investing in something and it driving a higher return to where you wake up with more money in the future was just the most interesting thing to me. It is the eighth wonder of the world, as Einstein said, compounded interest.
Right.
So I think from early on that always just tickled me, just the idea of that. You step further and, you're young, and I kind of looked at three things. I was like, okay, play Major League Baseball, fly Navy jets a la Top Gun, or go in the investment business. And baseball didn't end up working out. I played college baseball, but I was no savant. And so I actually debated, do I go in the investment business or do I go, fly Navy jets? And I actually called up a recruiter, a U.S. Marine recruiter, and said, hey, I'd like to learn about officers candidate school. And I sat down with that individual, and I quickly decided there's not a chance I want to, do that. And that was a blessing in disguise because, I know wonderful people in the armed services that are officers, and that just was not what God wanted me to do. And so, like you mentioned, I took my first job out of college. But if I back up a couple of years, I think the other thing that really crystallized me to continue to say, well, the investment business was the late 1990s. I lived in Seattle at the time, and I'll never forget. It's 1999, and I'd be at a sporting event that I'm playing in or practice or whatnot, and parents would come up and talk to my dad because they knew he was the stock picker. Right. And so, all he was really doing was telling them at that time, fear stock market failure, fear stock market failure, fear stock market failure. And that's what you have to do in certain junctures. Don't do stupid things. Please don't do stupid things. And the reality is that really left a huge impression of the psychology of markets and how damaging they can be. And it's very much of a Munger truth is how I think about it. Most of the success in investing at times is just don't do stupid things. Don't damage your capital because you leave yourself open for huge amounts of success in the future by not hurting yourself, in effect. And so I'll never forget that. I had a teacher in high school who knew, again, that that's what my dad did. And so in '99, he'd want to talk stocks with me in between classes. And I won't name his name publicly, but I'll call him Mr. B for lack of a better term. And I said, Mr. B, just go away from this one. It's going to cause more damage than anything. And I knew that as a 16-year-old kid, which is weird to think about. It's a very distinct oddity, and I recognize that. I knew that the damage could be way larger than anything else. Now, in reality, if you were a value stock picker, then you didn't do the stupid things. You didn't just save from the damage. You actually made money in the following 2 to 3 years in a pretty impressive way as markets crumbled, 50% using the S&P 500. So I just think it shows you, and this could be something we get into our discussion later, it shows you that there are huge rewards to being in disagreement with markets at times with businesses that produce good economics. And I think you just get to certain junctures where people forget about those ideals, and they are ideals because we've seen them proven time and time again. It's just not very fun, and it might not be very popular for certain seasons.
Excellent. I that's a really great rundown. Especially most recently in the context of the rebound in tech stocks. I suppose that's more of a knee-jerk reaction to the idea that the Fed would pause, maybe even cut earlier in the year that we saw, although it doesn't look like that now. But as interest rates seem to be more stabilizing, or at least the outlook for policy seems to be stabilizing, I think I just can't help feeling that tech investors might have sort of jumped the gun on that, and that's what we're seeing. Maybe there's some short covering in there, some releveraging of some kind going on. Trend following might even play a role in that, in terms of driving that forward. But it really defies fundamentals given that the high duration nature. Now, if we're talking about, the top 10 or top 20 components of the S&P 500, that's what's driven all of the return this year, with NASDAQ
Correct.
up roughly 20%. Would you characterize that possibly as a bear market rally in that segment of the market?
Yeah, so it's a good question. And I'll give you two contexts. I think I'll give you a longer run context to this and then just a short term. So we just got done talking about the break of the tech bubble and all the stupidity that went on. Yeah. If you look at the 3 years, there were massive bear market rallies during that 3 years. Okay. And I'm not talking about 10%, 20%. We're talking 30+% bear market rallies. To your point, I think it fits that picture really well. In other words, the markets are always going to do whatever it takes to frustrate the most investors possible. Okay. Because again, if it's going to be profitable to be in markets, it's got to be scarcer. Okay. Therefore, you crush these things. People think they're buying some kind of value bargain. They rally 30%. You think you're a genius. And then you wake up again, a year later and you're sitting, 15% below where you bought. And that's kind of the nature of bear market rallies. Also, to kind of put it in a baby boomer context, and since there's not many millennials that are 39 that have been around this business for very long, dead cats do bounce. That's just the reality to markets. Right. And that's the old saying, and we're kind of seeing it now. So that'd be what I would say just from kind of a pure market movement perspective. But let's go longer term. And Bill's harped on this a lot, so I'll give him a lot of credit for this on our team. If you go look at the top 10 market caps by decade, going back to the 1980s, that is a kiss of death for investors, okay? Right. Because it doesn't mean that one of those 10 big market caps globally can't be one of the 10 biggest market caps 10 years later, but the guarantee out of the data is that the 10 biggest market caps will underperform the S&P 500, and it is not uncommon for the S&P 500 to underperform greatly during some of those periods as well.
Right.
Okay? So I point that out because it's like this is a game of odds and probabilities and pathways for those probabilities, and the odds are that those stocks will underperform the S&P 500. And I would add further, we don't think the S&P 500 is going to do very well, much like it did, during the 2000s. The one thing the 2000s had going for it in comparison was interest rates were going to decline for a decade. Okay, and we don't have that luxury today. So we think a lot about that. In some respects, the large American big cap tech companies look like Japanese stocks did in the late 1980s. Really the only other groups on that list would be, at one point was like the Chinese tech stocks, but those have kind of all fallen back. So those weren't they didn't get to skip history either, and I don't think these will either. To use IBM as an example, IBM was a big company. It always was a big company, and yet it stayed one of the 10 largest market caps as you look through that data from 80 to 90, and yet you didn't want to own it, right? It stayed big. Right. You didn't want to own it. It didn't make the economic returns you wanted. Didn't do anything. So again, the idea that they're big, I think that's really that will be the anchor to the S&P 500. The only way the S&P 500 does as poorly as we think it will do is the big composition of those companies will drag it down. And the great part is, the secret to life is weak competition. So what are we saying? We're saying that the S&P 500 is going to do well, which makes our job easier, not tougher. Versus the last decade, that was really tough. So, and again, we're not taking the risks, as you know, we're not taking the risks that the S&P 500 is taking. We're doing it in other economic ways, which we can get into. But this is such a great world to be investing in, picking stocks. And, when I hear people negative about, value might be over because no one does it anymore. No, that's just wrong. That's false. What you do is scarce. That means it's profitable. That means it's valuable to the market. And that means other people don't do it. And that's what you dream of in your business.
I think there's an entire, I don't know if maybe calling it a generation, but there's an entire, let's say a cohort of investors and advisors alike in the business and in the market that have a very underinformed view on active investing anymore.
Agree.
And I mean, the last 10 years, macro didn't matter. A lot of fundamentals certainly didn't seem to matter. I'm sure that's not true, but that was sort of the sentiment that was going around, that was pervasive. And so, if you go 10, 12, 14 years back to the, 2008 point, a lot of investors have just simply bought into the indexing mantra. And I remember we did a webinar with Craig Lazara at S&P in 2018. And I've mentioned this before, but the most disheartening slide of all of that was the slide on where he shows that dispersion of returns within the index were at an all-time historical low.
Yeah.
Which I think continued as well beyond the time of the webinar, but
correct.
Basically Craig was there to say that active investing is dead, SPIVA is correct, and just go with the average.
Yeah.
Right.
But in the SPIVA studies, here's what they they look at the managers across the board. So they're treating them all as like an equal weight in effect, because they're saying here's what the funds or managers did, but they're dollar weighted in the marketplace. So no one goes out and runs a study and says, here's what the dollar weighted return of the investors were, which I'd love to see that data, because I know that money flows to where it's treated best. Okay. So, but if you want to make people look stupid, you do average weight, because the average is going to be worse than that dollar weight, in my opinion, on the margin. Okay. So I think that's an important point to make when you look at those studies. Make sure you're paying attention to how the data is cut. That's one thing I'd always say. But again, back to my point earlier, what you do has to be scarce. So tech bubble breaks, everyone becomes a value investor by 2005. They all can preach Buffett and Warren and so on and so forth. Okay. Now wake up today. Is that true? Or is it more likely to find people that say, I would never own certain kind of technology companies, diving in with both of their fists saying, oh, I figured out how they fit my criteria now. Okay. One thing you'll never hear us talk about is never. We'll never say, oh, we'll never own that industry. We'll never own that sector. Because back to my point earlier, your discipline doesn't change, but what the markets give you always do. And I remember we'd be sitting around with groups and, we didn't own an energy stock from 2010 to like late 2019, and we'd go to see investors that we work with in places like Houston, and it's like, when are you guys ever going to own oil and gas? And the answer is, well, we can't predict this. The market might give us an opportunity that we just never predict. And sure enough, it happened. In other words, it was almost kind of like, once you say it, it's going to make you laugh. So I point that out because I think the flexibility of investing is super important. And if anything, I think that's one of the real dangers right now. We sit across from investors or hear people say, well, I'm not going to own this place because it's not asset light. I'm not going to own this place because it's cyclical. And they put all these like never, ideas out there, and then they're picking between 4 or 5 sectors. And it is the narrowness of the S&P 500. I think that's also kind of reinforcing that. Now, what are they really doing? They're performance chasing. They're looking in the rearview mirror, like has always gone on, and saying, here's the businesses I want to own because they've gone up the most. Okay, now that tells you nothing of the future. That's the one thing we all have in common. We can't predict the future. The question is, between us all, when a majority of the financial advisors or when a majority of the stock pickers all agree on certain things and they make up the market, you just know that you probably can't make money agreeing with them. And that's one of the dangers of today. So I totally agree with you. I think most active managers call it the value space or in stock picking have given up on much of what they would have believed at the age of 25, 30, 35, because the last 10 years has made them, the pressure to conform has been too great, in effect.
Right. But you have stuck to your guns, and we've been sharing Smead Capital Management posts since I believe around 2010 or 11. Mm-hmm. And and that's a shout out to Tucker.
Oh yeah.
By the way,
yeah,
because Tucker actually got in touch with us and asked, was trying to ascertain what our interest was, and I I was an advisor in the 90s, and I spent about 15 years as a retail advisor, and I sort of grew up on the on the Warren Buffett philosophy of investing, buy and hold, finding quality, and in the full sense of the definition, and sticking to to it for the long term. And I saw Smead Capital Management as a beacon or a lighthouse of that philosophy of active management and concentration back then. And so that was where, as the editor of Advisor Analyst, we took a great interest in what you and Bill have been writing about for the last decade. And so I it's amazing to me that we haven't done this sooner. Mm-hmm. I got to say, I have really enjoyed. Know that. Yeah. I got to say, but shame on us too, because I think I would have loved to have done this much sooner. Get together with you and record a conversation, do a podcast with you. I've really enjoyed reading your blogs over the years. They've always been rich in insight and something that's in short supply, or seemed to be in short supply over that entire duration. And by the way, yours are some of our most read content on Advisor Analyst. So I don't know if you're surprised to hear that, but there is a cohort of advisors and investors who are still very much interested in what you have to say, and in terms of fundamental investing. And your latest one was very interesting, intriguing, I thought. Mm-hmm. So let's talk about that. Tech is bullish on oil was the title of your blog. In it, you mentioned two Mark Mills books, The Bottomless Well, which he published in 2005, and The Cloud Revolution, published in 2021, as a pretext to your thoughts on the interplay of energy and technology. What is the foundation of this component of the interplay of your larger thesis on energy and tech?
It's a great question. And by the way, just to give him a lot of credit, Mark Mills has been a great thinker, a great writer. I would say, the framework he's provided us as a firm for thinking about, the science of what we're dealing with in many cases. I just give him a lot of credit, and I thank him a lot for writing those books and, coming on our podcast. So here's what I would say.
By the way, I want to thank you, because I think your podcast is inspiring on the front of how important it is to read.
Oh, I totally agree.
A book with legs. We'll get to that. I do want to talk about your most recent one, but let's start. Sorry, I interrupted you. Go ahead with.
I like your excitement though. So with Mills, I think I'll teach your listeners about something that I think we were wrong, or maybe I'll just take the blame for I was wrong in. Okay, so if you asked me a few years ago, let's say 5 years ago, I would have been in like the Luddite camp. Okay, I would have been in the Luddite camp saying technology can't go that far. There's got to be a snapback, so on and so forth. Okay, kind of like there's got to be a mean reversion, like classic, I'll call it value Luddite idea. Okay, and the reality is it wasn't wrong from an investment implication perspective. It was wrong from an economic framework perspective. Okay, let me explain.
Sure.
I'll use the last 10 years. If you look at, the energy information coming out of the United States tied to electricity. Okay, so as Mills points out, the LED light bulb is one of the greatest technology creations in the modern era. It is the most efficient for creating light in a way that we've never seen. That's why you see it in cars, in your home, etc. Okay, now the fallacy is that the more efficient we become in our energy use, we will use less. And the answer is there's no proof of that.
Right.
Okay? And this is what you mentioned. This is the Jevons Paradox. And I'll explain it from a U.S. context. I'll explain the Jevons Paradox as well. So when you look at that data, electricity consumption has flatlined in the United States looking back a decade. And people would say, well, see, we're more efficient. Well, but again, we didn't use less energy because we were more efficient. So if you go into my home or we go into your home, what you'll find is that you have way more lights than you did in the past because they're more efficient, which means you can run the same utility bill and have a better lit home. That's called economic progress. And that's a beautiful thing in our opinion. Okay. Now, where the Jevons Paradox comes from is when they discovered coal in the UK and they were going to go out and they realized, okay, if this makes it more efficient, the commodity is going to disappear because the efficiency of using the commodity will drive a scarcity. And that was a fear. And Jevons, pointed out that it's a paradox, but he didn't think it was going to be true. What ended up happening was, yes, they got more efficient in their coal use, and the usage of coal expanded, obviously, the ability to mine it and find it and those kind of things. So again, if someone says, what does the Jevons Paradox teach? That the negative view of the future was of little value to people building the framework of economies and investors in those economies. Okay, so let's use the Jevons Paradox for today. Okay, the idea is that we're going to become so much more efficient in technology, and therefore we're going to use way less energy. And this idea of, call it in oil and gas land, the conversation we've been hearing lately is peak production. We're past peak production. Okay. The reality is great technology. I'll use the laser. And this is, again, I'm completely plagiarizing Mill's work. The laser is one of the most fundamentally incredible technologies of the modern era. But it's just the most intensive use of energy we've ever seen. So it doesn't, again, creating great technologies like that didn't create less energy usage. It created far more. I'll quote from his Cloud Revolution book, when Amazon is creating these server farms, it takes so much energy to move the data to these servers that what they'll do is that he pointed out, they use their snowmobile, which is they load the data onto the servers locally. They then put the servers on a truck, drive it across the country, and then place them in the server farm. Okay, so again, energy usage only gets greater with greater technologies. Also you think about this. People always forget that to move energy, you must use energy. So all these things playing on each other, I just don't think people have the framework to understand that because, they're effectively making the case we're going to go back to carbohydrates. We're going to use things like wood and other things. We're going to be more sustainable. And the problem is what they're actually saying is we want to go backwards in economic growth. We want to go to a lower level of economic growth. And between you and me, I don't want to. I want, God said, be fruitful, multiply, subdue the earth, have dominion. And I don't see that meeting that goal. That doesn't mean we don't want to be a good steward of what we've been blessed with as humans on this earth. That's not what I'm saying. But I'm saying that that's never happened through a country having worse economics. And I'll add one more thing. And this is something that was in his '05 book that I think people miss. The United States, between the time that the Pilgrims landed on Plymouth Rock to about 1920, had depleted 30% of the American forest, the fauna, the flora. Right? We're affected by that. From 1920 to today, but most of that happened post 1985. We repleted the forests of America. We have a larger forest today than we've ever had. So again, back to this idea of like economic growth and more energy consumption. Someone says, Cole, what's your takeaway from that? I would say a benevolent capitalistic society that creates wealth through the individuals that drive that can do incredible things. And so, again, I'm more worried about that the economics aren't going to be good enough for the individuals and households. That's the risk. Because when you're wealthy, we all know you can solve a lot of personal problems. And that's true in the economy as well. And that's where we should want to go from a framework perspective.
Yeah. So, I mean, in terms of the amount of electricity usage versus the growth of technology infrastructure, there's a potential shortfall there, right? I mean, if you consider, all the different kinds of sources of electricity now, whether it's nuclear or oil and gas, coal-fired, wind, solar, really only one or two, I should say, of those two electricity sources is a stable load, and that's number one is nuclear. That's a rather big deal here in Ontario and in Canada. And the other is hydroelectric, right?
Yeah.
But once you get into the other areas where you get into fossil fuels, that seems to be the area that's under attack, and there are entire segments of our geography that are powered by those two.
Yeah.
And then you get into coal, which is the legacy. That's really an interesting segue. I think there was a point that you made about the iPod.
Yeah, so in 1980, if you had to create the iPhone back then, it would have taken a Manhattan-sized office tower of electricity. Okay, so just think that fits in your pocket today. It's way more efficient. So again, to use the Jevons Paradox, we just have billions of them instead. Okay, so again, it's not a backwards. It's all for the forward. It's all for the progress. It's all for the economics. And to your point, the risk in this world is not having too much energy. And I think that's the biggest myth. Oh, we have too much energy. And then this idea we're past peak production.
Yeah.
No, the risk is that we have too little. That's a reality situation. Go to third world countries. You're not going to find a situation where they're like, gosh, we have so much power. It's crazy here. No, you go there and they're like, just sustainable, needed economic power supply, showing up every day and not having any issues. I mean, you can go to parts of the Caribbean and that's still a question. That's what goes on in most of the world. You have to remember that, I'll use Canada, the United States, or Western Europe, for example. We're rich.
Yeah.
We're rich. So when you're rich, you can make decisions that other people cannot. And so the idea that we need to build the framework around what every rich person in the Western world wants or needs, that's foolishness. I'll go one step further. In the case of Europe, they're a declining population. So, I mean, what parts of the West are doing is say, well, let's be more like Europe, who is dying slowly but surely. And therefore, as rich people dying, they're going to make different decisions in a growing country that's rich as well. And so I think there's even shades of that needs to be understood because, I mean, if you're going to have a dying population, you need less electricity. But you're not a very good model for Asia and Africa and other parts of the growing world. And that's something that's different. So I completely agree. But again, this is all going to be propelled by technology, by innovation, by economic growth, and by people's willingness to go out and create businesses and move their livelihoods and their employees forward.
I caught the, thank you very much, Cole, for explaining that. I caught the news item, I believe it was last week, that Germany had just closed its last nuclear reactor.
Mm-hmm. Yep, saw that too.
Yeah, and it reminded me of, there's a great movie that was produced by Ed Bertinsky called Anthropocene. I don't know if you've seen it. I've brought it up
I have not,
before.
no.
There's an entire segment in that movie about the coal mining, lignite mining in Germany, where they're trying to make up for their electricity, their power generation shortfall as a result of mothballing their nuclear reactors.
Yeah.
But when you see these lignite harvesters that are terraforming entire parts of the German countryside, it's mind-blowing. These machines are the size of buildings, and they have these gigantic scoops on a Ferris wheel, basically scooping up tons and tons of the land of land.
Yeah.
In these parts of Germany. But what was even more fascinating was that this is at such a at all cost activity that they are destroying towns in the process. Like entire towns and villages have had to relocate because the mines have bought the right to harvest all that land underneath.
Correct. What you're getting to, though, is, and I'll quote Milton Friedman, he said, if you put the government in charge of the Sahara Desert, you'd run out of sand within 5 years. Okay? And what are they doing? They're running out of sand. Their sand is, obviously coal. So now, again, to go back to your question on kind of like the nuclear. So in the long run, the cheapest, most accessible commodity will always drive the energy dominance in the world. Okay. So, if someone says, what's the most economic forms of energy out there? I would say, well, it's nuclear and it's oil and gas. Those are the two most economic from a price perspective. Now, we obviously know that, the historical model of building a big nuclear reactor and whatnot, that is probably, that has seen its peak and it's already waning. Versus, oil and gas hasn't seen its peak, I would argue. Now, you also get into your point, you get some geopolitical risks. Nuclear reactors in Ukraine seem a little iffy, just in the minds of most humans.
Sure.
Post Fukushima.
And there's also the irony of Germany having to buy its shortfall in electricity from France, which is all nuclear, which is predominantly nuclear.
Yeah. I agree.
Those are the unintended consequences of ESG, right? Or some of them anyways.
Well, also just of time.
Yeah.
I mean, when Fukushima took place, that put a big back burner to nuclear projects because it's like, hey, look at the kind of fallout from Fukushima as an example, from an act of God, right? A statistically tough event to figure out in advance. And I'm not saying everything went perfect there, but my point is this. Why did coal become so dominantly used during the Industrial Revolution? Because it was the cheapest, most readily available, resource out there. So that will never stop. What oil and gas has going for it that nuclear doesn't is you could blow up a gas tank and you just get exhausted fumes and flames, and you blow up nuclear and it's a little bit different reaction. Okay. And it has a little bit different fallout going forward. So I think that's the one advantage that oil and gas has relative to nuclear is the longer term problems from an explosion. I mean, it's as simple as that.
Right.
Now, it doesn't mean that nuclear isn't highly valuable in this framework, but again, so far, oil and gas is more palatable to the human in just their mind. Now, again, I'm not saying that because I'm the person saying, hey, we're not going to do more renewable. Okay, that's the catch. Again, my thesis is we don't have enough energy at large. Okay,
right.
And if someone says, hey, will renewable grow? Yes, I think renewable will grow because all energy is needed. But you got to remember that comparing like our discussion on nuclear versus oil and gas against talking about renewables, well, one is heavily subsidized and one is not subsidized really at all. Okay.
Right.
Or one is regulated and taxed and one is not regulated and taxed at all. And I think that's really a completely different discussion. So, I mean, I'll give you a number. There's been about $3 trillion spent globally into renewables. And I would just challenge anyone to show me what the economic return is as of this point. In other words, what has been the accumulated or cumulative economic return from that? And so far, I don't think we're in the double digits, which is really sad to say. Now, again, that will get better. Those technologies will get more efficient,
right.
But you have to remember that I'll use solar as an example. Solar is the least concentrated form of energy in the world because, yes, you get sunlight. Yes, it's cheap, but it's also not very concentrated. A gallon of gasoline is, like nuclear, it's so concentrated, it's so mobile. I look at the gallon of gas like the human mind. I could feed you bananas for 2 weeks and your brain can do things that a computer could never do on a mobile detached basis like that. And that's really how I look at a gallon of gas. I like to flex my petro masculinity ever occasionally, and I own a 2005 Ford Excursion, which has a 45-gallon diesel tank.
Right.
And it's kind of interesting to think about. I can get in a car in Phoenix and almost make it to Reno, Nevada, and to get to, say, the shores of Lake Tahoe in one tank of gas. The freedom and the flexibility that provides humanity to do something like that is incredible. And we actually cannot touch something like that yet in terms of freedom, flexibility. I don't have to stop, unless I got kids with me.
Right.
They reduce your freedom and flexibility. They're like owning an EV, but they're a bigger blessing, I think. So again, there's components that people aren't accounting for. I'll give you one other thing. This is back to the geopolitical idea. Let's say someone attacks the grid of Canada or the United States of America, and we all have EVs. Congratulations, you've shut down the American economy, the Canadian economy. Versus if we have cars that run combustion and you shut down the grid, guess what? You'd not take an extra risk. I actually think the world we're going to, just so you know, to tease forward, is a hybrid world. You're going to have a small battery with a torque motor to get you to speed. You're going to have a smaller combustion engine than the past with a turbocharger on it that will then run at speed. And that means even if your battery goes low, it can be recharged by the combustion engine. That is a more free world. That's a more flexible world. That's a world that can speed out of danger quicker with the electric motor. Huge benefits. So again, this is not a Luddite view. We're going to do great things. I'm going to get in a car in Phoenix, Arizona sometime in the next 20 years, and I'm going to sit in a car having cocktails with a friend, playing poker on the way to Vegas while not looking at the road. And by the way, that could be a combustion engine doing that. That could be EV.
Right.
So again, I think we're going to do far more. I think our cars are going to become far more important. We're going to do way more because of these blessings.
So the conclusion is that there will be continued shortages, right?
Correct.
I mean,
correct. And by the way, Eric Nuttall, from 9 Point Energy, does a great job of talking about the inventory shortfalls, and he talks a lot about this too. So I'll give him a lot of credit. We need far more energy, and what these governments are doing is they're arguing for investors to just invest far less, and that's a danger.
Cole, are you able to tell us the story behind some of your key long-term holdings?
Yeah. So in this space, since we're discussing it, I'll throw out a couple things that happened back to the psychology we talked about earlier. In late 19, there were three things that really stuck out to us. Okay. First off, Peter Lynch was interviewed in November of 19's Barron's magazine. Yeah. And he's the greatest growth stock investor of all time. And what was he talking about? He talked about seeing 3 baggers and 4 baggers out in E&Ps, which was like, wow. I mean, creme de la creme growth stock picker is talking about, exploration and production. Right. Sam Zell, billionaire Sam Zell, was out, who they call the grave dancer. He was out buying existing production in private markets that was in trouble. Okay. And then at the same time, you had Warren Buffett going out to do his preferred plus warrants deal with Occidental Petroleum. Okay. And I just think environmentally, you rarely get that many smart people agreeing at the same time against the market or really away from the market's opinion at the time. Now, that didn't mean you don't have to, look like an idiot. You have to look like an idiot often in great investing. And so you could get involved in that late 19 and you wake up in the spring of 20 and you're looking up at God like the wildcatter often is and saying, what did I get myself into? Okay. And the reality is you got yourself into a blessing. You just don't know it at the time. Okay. And so what that did is, again, we came into this thinking these are brilliant investors. These are great minds. We have to pay attention to great capital allocators. And the reality was that not only that, but then also, and I'll give Barry Bannister, Stifel Nicholas credit for this. He pointed out that commodities had never done so poorly relative to stocks looking back in over 200 years. And he had a great chart for showing that. So it's like you kind of add the probabilities up and you're like, gosh, I just lost a ton of money. But I know the odds are so much in my favor because no one wants to own this space. And so what we had originally bought Occidental Petroleum in late 19, got our head handed to us. We actually did a pretty large tax sale on our entire position, the Monday after Saudi Sunday. We woke up buying more Chevron in response to that because we'd already owned some Chevron. We got involved with Occidental Petroleum in, I think it was June of that year. We came back and started getting involved in ConocoPhillips later that year. And then, you fast forward, we made wonderful money on our Continental, and then we have Harold Hamm buy us out late last year. And where we've pivoted that capital to is, to your point about this supply tightness and like the fact that we need more energy, the longer duration the assets are right now in oil and gas, the more valuable they are. And so in a Canadian context, I think this makes the tar sands businesses very attractive because they're just longer duration assets. But also, we're about to do our webcast on APA Corp, what was formerly known as Apache, where, they sit in the United States, they sit in some of their production in the North Sea, more of their production in Egypt, about 50-50 US, non-US, but they're out doing offshore stuff in Suriname. Now, why would be interested in a business that is doing offshore, which typically has a higher cost? Well, because you also know it's a longer asset. And that's really what the market is missing is long-dated asset creation, long-dated asset production. If you look at the majors, they're getting more interested in the Permian, which is 7-year projects. It's a very short asset. And we don't think everyone will be able to go and reinvest for the next cycle, which is also why we think there's going to be a lot of consolidation. So Someone asked us the other day, it looks like Exxon's, kind of reinvesting in what they think will be good for them. And, if Shell's talking about going back to America, or coming to America rather than sitting in London, what does that mean to the majors? Well, the majors are waking up to the fact that they were wrong. They were just wrong in how they approach the world, which I would say is not uncommon, just so we're on the same page.
Right.
Typically, the majors come in at the top and pay the dumbest price. That's the history of the oil and gas business. So like XTO with Shell, the dumbest price paid in the open market. And so we were really glad, like in our international fund, that Whitecap's out buying the former XTO Canada because, again, we paid a much better price for those assets. But I pointed out because it shows you where we're at in the cycle. We will consolidate this industry because, again, not everyone will be able to reinvest. So the question is, if you want more production, can you actually get more production as a company by paying in the open market of, say, the Toronto Stock Exchange or the New York Stock Exchange to buy these assets and get more production? Or are you better off going into the field and doing it yourself? That's the capital allocation right now, okay? In anything outside of that production you don't want to grow, I would advocate that people are buying back their stocks because these stocks look cheap. So as we look at like what Occidental Petroleum's done, they made a major acquisition, they borrowed a lot of money, they got really great interest rates on that. You fast forward, what's happened? People went from hating their balance sheet to loving their balance sheet. What they've been able to do in the economics of their business, they're driving massive free cash flow, buying back stock like fiends. It's like a game of Pac-Man. It's so much fun. And that is exactly the policy prescription I would go out and tell anyone. We had Vicky Hollub, their CEO, out at our Investor Oasis in February, which we'll have to invite you out to. But she said, again, the backdrop is you have a government telling you you're not going to be around in 10 years. And then they call you the following day and say, invest $2 or $3 billion. And she said, you're just not going to do it. And so we agree. So I think the other thing too, and this is about like, the idea of learning and reading books. If we were having this discussion 7 years ago, and you said, Cole, what do you know about the oil and gas business? I'd say, not much. I generally can tell you some things, but I don't know a whole lot about the assets, the basins, et cetera. Okay. But then investment opportunity strikes, and what do you become? You become this learning machine where you're just trying to take in everything you can, learn anything you can, ask yourself tons of questions. And I think that is why investing is the last liberal art, right? That is a liberal education process. You're going to learn little bits and pieces from everything you experience. And the question is, who's willing to learn? Back to our never conversation earlier, there's a lot of investors that say, I don't want to learn about that. And that's fine. But that's one of our advantages as investors and the investors that are out there. If you're willing to learn, you can create way greater opportunities to make money.
I love that, by the way, that investing is the last great liberal art. I think that's a terrific way of describing the business. It gets often, I feel as though, I personally find, the whole idea of passive investing very, very sleepy, very uninteresting.
I agree.
But then, how exciting could it possibly be to, other than some of the net results from it? How exciting can it possibly be from an allocator's point of view to just say, I'm just going to do average. We're just going to buy the average.
William Sharp talked about this in 2002, and his quote that I love is, he said, as long as the active managers are there keeping prices close to value, both on the long and the short side, there's a free lunch, right? Yeah. But the question, to your point, is, are there enough? Are there enough active managers keeping prices close to the value? I would argue there's not. And therefore, it's not a free lunch. I call it be like a negative alpha lunch where you're like, hey, I thought I got something for free. I was hoodwinked, in effect. But he said it's easier to do that because you can go out and do arts and sports and entertainment, and you can enjoy your life easier. And I agree. I mean, this is a full-time job to go out and want to learn these things. But then again, it's also your passion. It's what you want to do with all your time, in effect, crowding some other things out. But the question is, who wants to do that? I mean, who really wants to go do that? And can everyone be good at it? And I just don't think everyone can be good at it. And it's tough as it is, even if you do want to spend a lot of time on it.
No, I think with as with anything, where people do get good at something, and in this case we're talking about investing, it does require a huge investment of time. But it's not just the time; it's the interest. You have to be interested.
Yeah, gotta be passionate.
From our perspective as a publisher, we tend to see significant spikes in readership when things go sideways, right? When markets are in drawdown, when advisors and investors alike are looking for answers, right? And so our traffic goes up, dramatically in those periods. It's contrary to what we're talking about, right?
Yeah.
I mean, the idea is to get in front of it, not behind it, not to react to it. But in terms of your thesis on energy, I know, in Canada, which is a very, energy rich economy, more and more Canadians, more and more Canadian advisors and investors are sort of getting on board this idea that after, 10 years plus of underinvestment, has led to dramatic, shortages in new production, right?
Yeah.
And that goes to your point that you have a choice. You can either spend on developing new properties, new sources, or you can acquire, right?
Yeah.
And to your point again, when you acquire, you're gonna, usually that's going to be at top dollar, but at least you fulfill some of your supply right away, as opposed to waiting 5 or 10 years for a project to come online. We talked about on another podcast. We talked about tourmaline tying up with Cheniere.
Yeah,
and in the LNG business, but this was coming. The news stories, the news feed was coming about this tie-up in the heat of the pandemic and the Ukraine, the Russia-Ukraine conflict, especially, blew it up, that Europe was going to be in shortage. But if you read it more carefully, what you saw was that these supply tie-ups between the two companies were coming online in 25, 26, 27.
long time out. But
Not 23 or not 22, not right away. There's no fulfillment happening now. It's happening 4 years from now, right? And so when you see what the time constraints are for this type of work, the fact that we've had 10 years of underinvestment, the amount of catch-up that's involved is huge.
Yeah.
I mean, the amount of money that's going to have to be spent on R&D, on exploration and development, is I don't know, it's incalculable maybe right now, because we're so far behind after 10 years of reacting to shale, right? 10 years of ESG, 10 years of that kind of policy making and the decisions that executives at the big oil companies made, in favor of cutting back on E&P and expanding, renewables. Now, they've been caught flat-footed, and I think the sort of flashpoint of all that is the war in the Ukraine and the threat to Europe. The energy vulnerability of Europe is the ultimate flashpoint of all of that policy making of the last 10 to 12 years.
Agree. Well, you remember on the deal side, so one thing that's important to highlight, so the bigger the market cap is right now, generally speaking, the higher the multiple it gets. So there's an arbitrage, I'll call it a corporate arbitrage, that can happen where, just think, do I poke a hole in the ground on my higher EBITDA multiple or free cash flow multiple or book multiple stock? Or do I go buy someone where I know exactly what they're already producing and I pay a lower multiple, and I can either do an all stock or part cash, part stock, or all cash deal, and I know it's accretive, and I know it's immediately going to translate into more production in my corporate entity. That is very easy calculus. To your point about consolidation, I mean, what are there, like 45 Canadian E&Ps sitting out there, with less than, $3 billion of market cap? I mean, it's crazy how many Canadian E&Ps are. So I think we're going to see a lot of consolidation, and a lot of it's just people saying, you know what, we can get rewarded in the stock market for being inside of a bigger company, having these assets inside of a bigger company. That arbitrage is going to go on. But then when it comes to, we're putting together our webcast for Apache, APA, And it's funny, I was just going through, so back in 2019, they struck a deal with Cheniere. Now, here's what's interesting. Cheniere's lenders for the facility to liquefy natural gas and export it said, hey, you have to get a long-term commitment supply. So they struck that in 19. Okay, so
Right.
what we know right now is that's going to start up here in Q3 of 2023, to your point about the time it takes. But
Right.
here's the catch. Because the lender needed a fixed long-term contract, there's a guaranteed spread to APA Corp. In other words, it doesn't matter what nat gas prices are. They're going to collect a spread regardless of
Right.
what the spot price is. Okay, so they're going to be treated like a croupier. So what I also think we're seeing is, there's niche parts of the oil and gas business that are creating economics that you might not necessarily see screaming at you in stock prices. To your point about, moving this stuff around the world, if Europe needs more energy right away, yeah, you can liquefy natural gas. That costs a lot of money to do. Go look at the oil tanker market right now. I mean, we've been buying Frontline International Fund, and we've owned that for a little over a year. We were liquidating the oil tanker market because steel prices were high enough that it incented you to just pretty much scrap your boats at the 20-year mark, and the cash rates you were getting on a daily basis to run those were too low. So what was happening is people would have 5 boats hit the 20-year mark, and they would only reinvest in 2. So I think in this pandemic, post-Ukraine world, I really look at this as a fractured dollar system where there's all these niche places to make money that didn't necessarily show up like they did, pre these events taking place, where you can make a lot of money. But again, you'd have to learn a lot about the oil tanker business overnight, or you'd have to
Right.
learn a lot about the oil and gas business. And again, I mean, do 22-year-old Americans and Canadians, go to a 4-year education and say, you know what I really hope to do in life? I really hope to be a genius in those industries. And the answer is no. They
Yeah.
think that the only way to become a billionaire is to go out into a technology and create a business and have a VC firm back it, and you go on and do these things. No. I mean, I look at John Frederickson in the oil tanker business, billionaire. I look at Harold Hamm in the oil and gas business, billionaire. You mentioned Tourmaline. We don't own Tourmaline, but I think Mike Rose is a friggin' genius. I admire the guy. I think the world of him. I have huge respect. I just tip my cap to him. A lot of investing is also just studying other great capital allocators and billionaires. We did a book on Jay Gould, who was the railroad baron.
Right.
I mean, Jay Gould he was the Warren Buffett of his era. The only reason you don't know about him is because he died before he could endow New York University. That's why we don't ever hear about Jay Gould today. So,
Right.
So now one other thing, and this is where we could pivot if you want, but you can find examples where people have become billionaires in the last 10 years off of some of these commodity businesses that no one wants to touch. So what we see going on in the coal business, again, 7 years ago, coal, what is the coal
Yeah.
business to me? I
I
don't
was
know.
just going to ask you, but yeah, go ahead.
Yeah, so I mean,
Yeah.
I didn't know anything about the coal business. I couldn't even tell you what
Right.
high-grade coal was or low-grade coal was or anything like that. But again, that's what the great part about the markets. Hey, there's good economics out there. Maybe you should want to learn more. Yes, I do.
Right.
I want to learn a lot. So,
Well, yeah, I mean, how else are you gonna properly exploit the inefficiencies in the market, the inefficiencies in the economy? How are you going to properly do that? It's not something that happens. Maybe passively you end up owning these things, but that there's no real economy in doing that, right?
exactly.
I mean,
Well, it
so-
reminds me of the old Smith Barney commercial, and I can't remember the actor.
I want to just say one thing, like Cole, because we've been talking about energy.
yeah.
You're not an energy fund.
No.
Like so
No.
I just want to make that clear, because energy is a focus of your investment strategy today.
Yeah.
That could all change when things change, but for the time being, that's where your focus is. It's not like, so I just want to clarify that you're actually a go anywhere strategy. I don't want to make the mistake of leaving people thinking that, oh, Cole Smead's an energy investor.
Yeah. Well, to your point, we didn't own any energy for almost a decade.
Right.
Like I said earlier. So, if you think we're crazy on energy, we own mall REITs in the United States. Malls are dead, right? It's just a dead business. No millennial's going to move out of the city was the story 10 years ago. Look what's happening where we just don't have any supply. European banks can't make any money. So I love that kind of stuff. We just feed on that because, again, it's reasons to learn, ask the question. I think the other thing it highlights too is when you're in these industries, tough times create the better moats. It creates better companies, seeking out their competitive advantages. Consolidation usually feeds into that moat idea as well, because the tougher things get, people tend to consolidate in tough eras. Oh, I don't have enough production. I don't want to reinvest in that production. I better consolidate because we're not going to go through that next cycle. To your point earlier, it always reminds me of the Smith Barney commercial with the British actor. He says, he says a good investment's not going to come up and bite you on the bottom. And then he comes back to the old Smith Barney saying to say, at Smith Barney, we make money the old-fashioned way. We earn it, right? And I love that because, again, that is what the active investors should be seeking to do, right? No one is going to hand you something and say, here's a profitable way to go make money. The learning process is where that comes from, and where that's continued to take us. Again, in the learning process, it's like you learn about one energy source. And what you learned on that becomes a cumulative advantage to you as an investor as you continue to think about those same things. Because, in many bull markets, you'll get rotational opportunities where it's like, great, we saw the wonderfully hot move in many, energy-related commodities, including coal, and now the pricing of coal's backed off. Well, what you're waking up on is where, if you go, we ran a screen, I think we had in our piece, but we ran a screen to say, okay, it was like Europe, South America, North America, developed Asia, and maybe one other geography. We said, okay, let's go look at a coal business where they do at least 80% of their business in coal, whether it be met or thermal, with greater $3 billion of market cap. Okay. And I think we came up with six globally. That's crazy to think about. But to take it one step further, only one of those six had debt, net debt. Now, here's why I say that. Normally in commodity businesses, they're cyclical. Because, again, you can't predict the future of the commodity. Right. That's the tough part. Now, in any commodity, I would say always look at supply. The tighter supply is, the easier it is to do what you do in that market because there's less competition. But it's also really tough to have a bad business when you're cyclical, but you don't have any debt. Because debt's what kills you in cyclical businesses, right, ultimately. So, again, okay, so you own a business. You can't predict the future of the commodity. You know you have tightness in supply, and you know you can't go bankrupt tomorrow. Wow. Again, you're taking out the negatives. Most of investing is a negative art. And so I look at the coal business today as, okay, do any of those bright 22-year-olds in Canada, the United States, wake up and say, gosh, I want to become a coal baron. I want to make a pile of money and become a billionaire in the coal assets. No, that does not happen. No. So again, weak competition. Who are you really competing with? Let's use the big U.S. managers or the big Canadian managers. With who they serve and the institutions they want to work with. Can they own those assets? And the answer is no. So who are we competing with? Well, we're competing with hedge funds that have a duration much shorter in their investment cycle than we do. Great. I like that. In other words, it's disintermediation. It's the wrong owner. Right. In terms of timeline, we're a slow owner. We like owning things for a long time. So again, we're just continuing to get it down to where there's fewer and fewer investors that we compete with. And those hurdles are probably going to be easier to overcome. Back to your point earlier, when you started off by asking about tech, debating whether tech's cheap right now, it's like a million people have answers on that. And you know what? I can't be 1 in a million. I just know that. Therefore, if I can be 1 in 10, my odds are way greater of having investment success when I buy a stock.
That's brilliant, Cole. I to put it that way, I think we're because we're human beings, right? We're behaviorally challenged by recency bias, confirmation bias. We look at tech and we say, well, so many of these tech names, are down 50, 60, 70, 80, 90% from their February 21 peak.
Not enough.
Right. Yeah. But what were they worth in the first place, aside from the fact that, they're very high duration stocks, like extremely high duration stocks in a market where, duration risk couldn't have been higher.
Correct.
Given that we were heading into, a period of rising rates. It gives a whole new meaning to, we know the price of everything and the value of nothing.
Correct.
Right? So, Cole, I thought today we would have time to talk about your conversation with Margaret O'Mara on your podcast, but I think we'll leave that for Raise Your Average. I think
Sure.
that'll make for a great
Fun
conversation.
discussion. Yeah.
Very, very interesting. I wanted to ask you about Glencore and
Yeah.
tech, because, at least by the accounts, it looks like, Glencore is seeking to take advantage of ESG in order to justify its bid for tech.
Yeah.
What are
Yeah,
your thoughts on that?
So I'll give your listeners a book, The King of Oil, which is the story of Mark Rich, and you have to read that book.
Okay.
I think that book really intensified my interest in this arena. I read it years ago, but it made me wake up and ask the question, well, I didn't know you could get that wealthy in commodities because there's just not that many examples. Okay. And I think the story of Glencore. Now, by the way, the Glencore is, just to take everybody back, their IPO was timed at the top. Those people are very smart. They sold their stock into the open market at the dead flat top. Okay, that was 2011. By the low in Glencore was 16, which was the low in metals and mining in general. So fast forward to today, where Glencore is the 800-pound gorilla in commodity markets. They know better than anyone how to trade those. They know better than anyone how to buy those and own those. Okay. And then you have Teck Resources, which, I think back to 2009, where Tech's like, market cap less than $1 billion. It was like a tiny company because of the circumstances around it, but is effectively a copper mining business and a metallurgical coal business.
Right.
And it's, obviously controlled by the Cavill family. So what's happened is Tech's come in. The Cavill family said, "Hey, we want to spin out our thermal coal, or our metallurgical coal business, which they were going to refer to as Elk Valley Resources (EVR). I assume was going to be the ticker of that, because they wanted to detach it from the copper. Think of good commodities, bad commodities. Okay, that's what we're going to. There's this dual commodity world that we're moving to. Okay, so that was their hope. But now here's the catch. You think, oh, you get away from met coal, you want to get as far away from it as possible. Well, that wasn't true. Someone called this greenwashing in a discussion like this. I wouldn't disagree with that. I would just call it disingenuous conversation. But what Tech was really doing is they were saying, we want to get away from the coal business so that our investors can own the copper assets. But they weren't getting away from the coal business for 7 years through a royalty structure, and then also preferreds that they own. So they can completely control this business, but at the same time, they were supposedly out of the business. Okay. So that's all going down. We were actually doing a lot of research on the EVR part because, again, it's going to be left for dead. That thing is probably going to spin out, get obliterated because there's going to be no market cap and you're not going to get meaningful cash flows for years. So you flip and you have Glencore call up and say, hey, we're going to put a number on that coal business. And they valued it at roughly $8 billion. And then they're going to go out and compete to figure out what the copper assets are worth. Okay. Well, here's what it does. To your point, we know the price of everything. We know the value of nothing. Here is someone setting a bid on the coal asset that Tech currently owns. We think it's worth $8 billion. Great. We got a benchmark for what a private market buyer would want to pay for that business. And what Tech would like to do is they'd like to merge the coal businesses together. Now, we were talking to someone again in this learning process. How strong are Tech's coal assets? How strong are Glencore's coal assets? Well, the folks at Glencore are geniuses in the coal market. Okay, they have the top quartile assets in that industry versus Tech doesn't. But at the same time, you'll create a business that has, the largest scale in the world in the coal business, far and away, both from a market cap perspective and a capital investment perspective. So we think that part of it's very interesting. And what else we find interesting is, again, it highlights this duality to commodities. There's good commodities, there's bad commodities. But here's what's interesting about the Glencore side. Is Glencore getting out of the coal business like, in effect, Tech is hoping to? And the answer is no. How they would do that is it'd be a spinoff. So back to the Mark Rich book, since I started there, The King of Oil. All the partners of Glencore that currently own the shares will receive their share on a pro rata basis of the spin out of the coal assets. In other words, Glencore wants to own the coal business. Glencore spends no money on their coal business. They pay out 100% of the income or free cash flow of the business. And it is not, this, I know it sounds crazy, but it will not be crazy as we're looking at this. As of right now, it looks like that business will be kicking off a 30% dividend, more than likely, Okay. Again, this is, again, not because you're a genius, not because you're super smart, not because you've had to do analysis way greater, but because you as an investor or the investors you work for allow you to even do that work. Think about those businesses, make those investments. So again, we're terribly interested in the saga. We have nothing that we own on either side of this, but we're really interested to see what is left after this. Just to put some numbers on it, it looks like the EVR plus the coal assets of Glencore will be like a $25 billion enterprise value. Okay, now how much of that will be in debt? How much will it be in cash? How much will that be publicly traded market cap? We don't know. But again, we can see there's like $7 billion of cash flows, of free cash flow that could come off this. So, what's our advantage? Well, we can own it. That's one of our advantages today. And then the second advantage is, how do we not overpay for it? Right? That's the other thing we have to our advantage, which, to your point about, are tech stocks cheap or not? The biggest, danger that's been is people just overpaid for assets. So we're going to the opposite side of the room, places the market that other people can't play, places that the indices don't own anything, and extracting high returns. Some would call that mafia investing. I would agree with that. I mean, I want to extract really high returns in places where other people don't want to invest. And that is one of the things we get today because of the ESG phenomena, because of the institutional investors that want that so bad. If people want to get wealthy, which, if I haven't said this on the podcast already, I want to get insanely wealthy, and I want investors that want to get insanely wealthy. That's our goal. Yeah. That's the fun part to this whole story. That's
the whole match. That's the whole shooting match.
That's why we're here. That's why we're on this podcast.
Yeah, absolutely. Wow, Cole, that's fascinating. I want to thank you so much for your generosity, the generosity of your incredibly valuable time. It's been an enormous pleasure to have you on the show. I'm looking forward to our very next conversation on Raise Your Average.
Yeah, and I really appreciate the chance to come on as well. By the way, I'll have to loop you in sometime when we do our quarterly book list. I'll have you on as our guest host to a Book with Legs podcast and say, hey, what are you reading? Because we're always looking for recommendations, so we'd love to do that as well.
Awesome. I would love to take part in that. Thank you.
Awesome. Thank you so much.